This AI-generated podcast is for general information only and does not constitute financial or legal advice. Please consult a qualified professional. Welcome to the Luxembourg Fundcast. Produced by Bertrand Mariot, a regulatory lawyer qualified as avocat à la cour in Luxembourg and Paris, this show brings you reliable insights on Luxembourg regulations sourced from curated official references. This episode is current as of 22 February 2026.
It's really good to be back for this one. We have a very precise mission today.
We certainly do. You know, usually mid-February is when things are just sort of starting to settle into a rhythm for the year.
Right.
But looking at the stack of updates from the CSSF this week, it feels like they decided to do a massive spring cleaning a month early.
They really did.
So today we are unpacking 3 critical updates from mid-February 2026 that really tighten the screws on how funds operate. We're looking at a major expansion of transparency rules that affects all UCITS ETFs. We've got some incredibly strict new definitions on what counts as ancillary liquid assets. And, of course, the latest FATF country alignment, which dropped just a few days ago.
And just to frame this immediately for everyone listening, this isn't just about updating a line in a prospectus text or filing a standard document.
No, it's highly operational.
Exactly. It is entirely operational. It's about calibrating your treasury controls for cash caps so you don't accidentally breach a ratio. And it's about ensuring your automated screening filters actually caught the 17 February update to the high-risk lists.
Because if you miss that update,
your filters are currently letting things through that they absolutely shouldn't be.
That is the nightmare scenario for any compliance team. So, let's dive straight into the takeaways. If I am running a board meeting or a compliance review this week, what are the big headlines I need to be worried about?
Well, if we look at the landscape, there are really 3 massive shifts. The first one concerns the scope of exchange-traded funds, or ETFs. For a long time, there was this feeling that passive funds operated in a somewhat different lane than active ones.
Right. The idea was that if you're tracking an index, your holdings are basically public knowledge anyway.
Precisely. But as of the 17 February 2026 FAQ update, that distinction is effectively gone regarding transparency. The regulator has clarified that all UCITS ETFs, all of them, and I emphasize all, not just the actively managed ones, they must publish their full portfolio holdings to investors.
So the passive index trackers don't get a pass anymore?
No pass at all. They have to disclose full holdings at least quarterly, and they have a maximum lag of 30 business days to do it.
That is a significant shift for the passive side of the market. The regulator is basically saying, show us the receipts.
That's a good way to put it. Now, the second big shift is about cash limits. We have talked about the 20% rule for ancillary liquid assets before, but now we have a hard boundary on the definition itself.
A hard boundary meaning no room for creative interpretation.
Right. The concept of ancillary liquid assets is now strictly limited to bank deposits at site, and there is a firm cap of 20% of net assets.
So deposits at site, meaning cash you can access immediately, right? Not term deposits where your money is locked up.
Exactly. Immediate access. And here is the really interesting part for the modern treasury teams out there. E-money tokens are permitted, but only for processing subscriptions and redemptions.
So you can use them for the plumbing of the fund.
But you cannot store value in them.
Got it.
They must be converted as soon as practicable. You absolutely cannot park assets in tokens.
Right. No parking assets in tokens. That feels like a very direct response to how market infrastructure is evolving. And what's the third takeaway?
The AML trigger. Circular CSSF 22822 has a new annex, version 17, February 2026. This is the updated list of high-risk jurisdictions. Professionals must align their increased monitoring lists immediately.
And we're not just talking about obscure jurisdictions here, are we?
No, we have specific places like Monaco and the British Virgin Islands explicitly listed in the source as requiring increased monitoring.
Okay, let's unpack this, because Monaco and the BVI are huge partners for the Luxembourg fund industry. That alone is going to create a lot of friction. But before we get into the granular rules of how to handle that friction, we really need to set the scene. What is the baseline we are working from? Because the CSSF also dropped some new statistics recently.
It did. We have fresh data. The global situation as of 31 December 2025 was actually just published on the 19th of February.
And what are the numbers looking like?
The Luxembourg fund industry currently stands at 6,199.370 billion euros in net assets.
Over 6 trillion euros.
Yes. That covers 3,036 undertakings and 12,317 subfunds.
It is massive.
It really is. And why this matters is that this data is the authoritative benchmark for board packs and market sizing. If you are reporting on market share to your investors or trying to explain to a board member where they sit in the grand scheme of things, these are the official numbers you use.
It definitely gives weight to the regulatory obligations. When you manage over 6 trillion euros, the regulators simply cannot afford ambiguity.
Exactly. So we have a 6 trillion euro industry that is being told to tighten up its operations.
Let's look at the mechanism of these new rules, starting with the ETF transparency update. What is the regulator actually solving for here? Why force a passive fund to publish what everyone assumes they already know?
They are addressing information asymmetry. This is a classic market structure problem. In the ETF world, you have what we call a two-speed information flow.
Right, because on one side you have the authorized participants.
Exactly. These are the big banks or market makers who actually create and redeem the ETF shares directly with the fund. They need to know exactly what to buy and sell to keep the ETF price in line with the underlying assets, so they need the data daily.
And they get it daily.
Yes, they get a daily portfolio composition file. But the broader public, the retail investor sitting at home, doesn't get that daily file.
So there's a gap.
A huge gap. The regulator is concerned that if the gap between what the banks know and what the public knows gets too wide, it's fundamentally unfair. So the new mechanism standardizes the public side. Quarterly publication is now the absolute floor. You can do it more frequently if you want, but you cannot do less.
It levels the playing field, or at least ensures the playing field isn't completely hidden in fog for the average investor.
Exactly.
And what about the mechanism for these ancillary assets? Why define cash so strictly as sight deposits? I mean, isn't cash just cash?
You would think so, but in fund management, cash can sometimes become a very creative term. The regulator is trying to prevent a UCIs, which is supposed to be an actively invested fund, from drifting into becoming a cash fund.
Because if you were sitting on 40% cash, because you were scared of the market,
you aren't really delivering the strategy you sold to the investor.
You're basically charging management fees for a savings account at that point.
Exactly. So the 20% cap is the standard. Breaches are allowed only for strictly necessary periods and exceptional circumstances. It is a guardrail to keep the fund true to its label.
Okay, that makes a lot of sense. True to label and information symmetry. Now, I want to get to the part our listeners really value, which is the operational playbook. Because knowing the rule is one thing, but implementing it without breaking the back office is another. How do we actually handle this?
We should break this down into 3 specific protocols, and we really need to prioritize them based on Regency.
Then let's start with Protocol 1, the FATF update. Because you mentioned immediate earlier, and in compliance terms, immediate usually means you should have done it yesterday.
It does. The trigger here is the publication of the CSSF 22.822 Annex on 17 February 2026.
This is what is step 1.
Step 1 is incredibly simple but critical. You need to physically download the PDF and log the version date.
Just log in the date.
Yes. You need to be able to prove to an auditor later that you are specifically using the version from the 17th of February. It sounds trivial, but version control is where so many governance processes fail.
And step 2 is the actual screening.
Right. You need to update your screening tools with that new list. Let's look at the actual names. The list of jurisdictions under increased monitoring now includes Algeria, Angola, British Virgin Islands, Monaco, Syria, and Venezuela. And the high-risk list includes the DPRK, Iran, and Myanmar.
Let's pause on that for a second. If I have a client in Monaco or perhaps an underlying asset structure in the BVI, which, as we know, is very common in private equity structures that feed into Luxembourg, that's a hit.
That is a definitive hit. And this is where the operational friction comes in. You cannot just ignore it because they were already onboarded cleanly last year. This leads directly to step 3, which is to run a delta scan on clients and delegates.
A delta scan. So checking the difference between who was clean yesterday and who was flagged today under the new rules.
Exactly.
Yeah.
If you have exposure to Monaco or the BVI, you must document the enhanced due diligence applied. You need to show on paper that you have applied a higher level of scrutiny following this update.
Very clear. Update the list, run the scan, document the extra checks. Now let's move to Protocol 2, which you're calling ETF transparency engineering. Why use the word engineering instead of just disclosure?
Because it is not enough to simply publish the data on a website. You have to control the flow of that data. There is a real gold nugget here regarding governance and insider information.
Go on.
Step 1 is the standard paperwork. You must update the prospectus to reflect the quarterly publication frequency and the 30-day lag. That's the easy part. But step 2 is the engineering part. You need to formalize agreements with your authorized participant.
The banks and market makers we mentioned earlier.
Right. They are getting the portfolio composition file daily. But think about the mechanics of that. If they have that data and the public doesn't, they legally possess inside information.
Ah, I see.
They must sign confidentiality clauses. You need to ensure that this inside information isn't leaking selectively before the official public release.
Because if they are trading on that info for their own proprietary book, outside of the specific arbitrage mechanism they are authorized for.
That is market abuse. Potentially, yes.
Wow.
That brings us to step 3. Implement market abuse procedures. You need to be able to demonstrate to the regulator that the daily data flow to the banks is contained, monitored, and legal.
That makes perfect sense. It protects the overall integrity of the fund. Now let's talk about Protocol 3, Treasury Hygiene. This is about that 20% cash cap and the e-money tokens we touched on.
Precisely. Step 1 here is foundational. Define ancillary liquid assets in your internal policy exactly as the FAQ does. That means explicitly using the term sight deposits. If your policy currently says something broad like cash and cash equivalents, you need to change it immediately. Equivalence is far too broad now.
So no creative definitions. No short-term money market instruments sneaking in and counting as cash.
Not for the specific definition, no. And step 2 is operationalizing that. Hard code the 20% cap in your pre-trade or daily monitoring systems. You want the system to flag it before you breach it. You really don't want to find out at the end of the month that you were sitting at 25%.
And what about those e-money tokens? You mentioned they are strictly for the plumbing of the fund.
That is step 3. If you use e-money tokens for subscriptions and redemptions, which is certainly becoming more common for operational efficiency, you need to create a specific log showing they are converted to sight deposits as soon as practicable.
As soon as practicable. That is one of those great legal phrases. What does that actually mean in reality? Does it mean instantly? Within an hour?
The key is that you cannot treat them as an investment asset. If you hold them over the weekend simply because the FX desk was closed, that might be defensible. But if you hold them for a week because you think the value of the token itself will go up,
that's a breach.
That is a clear breach. Do not hold them as assets. They are for transit only.
So if I'm holding a stablecoin for 5 days just to see what the market does, I'm in trouble.
You are operating outside the rules.
Which brings us perfectly to the friction points. Where do things usually go wrong in these scenarios? Because the rules on paper are very clean, but operational reality is always messy. What are the failure modes we should be watching out for?
I have identified 5 major ones. The first one, failure mode 1, is what I call the stale screen.
Just using the wrong list.
Exactly. Using an AML list from January. If you miss the 17 February version, you might be onboarding a new client from a listed jurisdiction like Monaco without applying the required increased monitoring tag. Imagine trying to explain to the CSSF why you treated a Monaco client as low risk 3 days after they were officially put on the increased monitoring list.
That is a straight compliance breach.
Yes, and it's an easily avoidable one if you just update the software. Failure mode 2 is the active assumption.
What does that mean?
This is specific to the ETF managers. It's the mistake of assuming your passive ETF doesn't need to report holdings just because the previous guidance over the years focused so heavily on active ETFs. As we discussed, the CSSF has now clarified the scope is all UCITS ETFs.
So passive managers really need to wake up to this one. You can't just sleepwalk through this requirement because you happen to be tracking an index.
Exactly. Now, failure mode 3 is the cash drift. This is allowing your cash buffers to drift above that 20% limit without a documented exceptional circumstance.
What actually counts as exceptional, though?
A massive redemption request that you know for a fact is coming tomorrow, or a total market freeze where you literally cannot deploy capital. Those are exceptional.
Right.
Just wanting to be safe or waiting for a better entry point in the market is not exceptional. That is just active management drift. You can't just tell the regulator, we liked being in cash. If there is no formal memo explaining the exception, you have no defense.
That is a very important distinction. And related to that, what is failure mode 4?
The token park. We touched on this with the e-money. It's holding e-money tokens for days. They are strictly for transit, not for parking liquidity. If you are sitting on tokens, you are likely outside the defined boundary of ancillary liquid assets.
And finally, failure mode 5.
The asymmetry. This is the governance risk we discussed regarding the ETFs. Giving authorized participants the daily data without a signed confidentiality framework creates a severe market abuse risk.
Because you're handing out privileged info.
You are giving select people inside information without the contractual controls to keep it inside. If that data leaks and someone front runs your funds rebalancing, you are responsible for that leak because you didn't secure the flow.
That is a serious list of failure modes.
Yeah.
It really feels like the era of good enough compliance is over. The regulator wants precision.
They do.
To keep our listeners completely on track, let's do a quick checklist. If I am sitting at my desk right now, physically, what documents or folders should I be pulling up to review?
Let's do 4 checks. First, review. The circular CSSF 2282822, NX specifically version 17, February 2026. Check. Is this exact PDF saved in your compliance evidence folder? If you still have the January version in there, archive it immediately.
Done. Second check.
Review. The UCIT's prospectus. Check. Does it state clearly where investors can obtain the full holdings and the frequency? It needs to explicitly say quarterly. If your current prospectus says semi-annually or upon request, that is likely insufficient right now.
Third.
Retain. Evidence of simultaneity. This goes back to the authorized participants. Check your IT logs. Do they show that the APs receive the daily data via secure channels at the exact same time? And crucially, do you have those confidentiality agreements signed and filed?
And the final check on the list.
Retain.
Right.
Treasury exception logs. Check. If the 20% cash cap was breached at any point in the last month, is there a formal memo explaining the exceptional circumstances? If you breached it and didn't write down the reason at the time, it looks like negligence, not a strategy.
That is incredibly actionable. Now, looking at the calendar, what specific dates do we need to be aware of? Because, as we all know, the clock is always ticking in Luxembourg.
Well, we are already in the thick of it. 17 February 2026 was the major milestone. That was the publication of the updated FATF Annex and the UCI's ETF FAQ version 23. Those are already active. If you haven't acted on them, you are technically late.
And the market statistics we mentioned at the start.
Right. 19 February 2026 was the publication of the December 2025 UCI statistics. Very good for your internal reporting and board packs.
And looking forward, there's a very big survey coming up, isn't there?
There is. Tomorrow, 23 February 2026, is the official launch of the CSSF annual AML-CFT questionnaire for the year 2025.
That is always a massive project for any compliance team. It's certainly not just a simple yes or no form you fill out in an afternoon.
No, absolutely not. It requires significant data extraction from almost every corner of your business. And the final submission deadline for that questionnaire is 3 April 2026. So the clock really starts ticking tomorrow. You have about 6 weeks to gather an entire year's worth of data and submit it properly.
We have covered a huge amount of ground today, all the way from over 6 trillion euros in aggregate assets, down to the very specific way you are allowed to handle an e-money token for a few hours.
It really highlights the level of detail required in this industry today. It is no longer enough to just raise capital and invest it. You have to engineer the flow of that capital and the data surrounding it with incredible precision.
Absolutely. Transparency in this industry is a lot like a good window. It needs to be perfectly clear for the investors who are looking in, but it has to be robust enough to keep the draft out.
That's a great way to look at it. Keep the draft out.
Follow on Spotify or subscribe to Rigore Media and Bertrand's MERUX on YouTube. Connect with Bertrand on LinkedIn. Visit bertrandmurillo.com. All links are in the show notes. It was the Luxembourg Fundcast for you today.